Good morning, options trader. Steve Gans here, and I want to share a concept with you. A couple of days ago, I had shared a trade where I was thinking that Apple was likely to roll off of this roughly 235 point range or so. So I had brought up the concept of a specific Apple trade, and that was this trade right here. I proposed two. I proposed selling a call spread or buying a put spread. This is one where I happen to have chosen to sell the call spread. They were essentially the same trade. They were going to play out the same way. So selling the call spread, that trade is nicely profitable at this stage. It's up about 32%, about $85. So I want to show you how trades can evolve over time, and how an options trader that understands specifically how to model and then place adjustments can greatly improve their returns in their options trades. So in this particular case, I am getting the sell-off that I had anticipated or was expecting with this trade, which is awesome. So let's say that in addition to that initial premise I had, where I did not expect Apple to go above this 235 range, it's now done close to a 50% retracement down to what I would consider to be some support here, right down in this 215 range or so. We can see that that used to be resistance, and then when Apple popped through, more often than not, that resistance will become support. So if my premise is that we may have support in that 215, 216 range, maybe even a little higher, maybe even 220, but I think I'm a little safer at that 215 range. What could I do to this trade to potentially increase the amount of potential profitability in the trade? As we can see right now, this has a max loss of 232 and it has a max profit of 267. If I came in and choose to sell a put spread, a 215, 210 put spread, let's see what that does to those variables. So I'm going to include that one, and then I will include this one. So that dropped my max loss to 132. So it basically gave this trade a much greater reward to risk ratio. Now my reward or max profit is 368. My max loss is 131. So in both cases, this trade improved by the fact that I ended up adding that additional spread. Now, what is my trade-off? Because any options trade has a trade-off associated with it. In this case, my trade-off is that I did add downside risk into the trade. If I am wrong, and we come back to this Apple chart, and Apple comes down here to 215, and it ends up going through 215 to the downside, that's where the risk in this trade, the additional risk that I chose to take on, comes into play. Now we can see, looking at our T0 line here, that it's not an instant drop-off until you get late in the game with this. So for right now, I am perfectly comfortable going ahead and modeling out this risk, again, as a paper trade, sharing this with everyone. So I'm going to go ahead and save this trade, and I'll just leave that as Apple, and now it is an iron condor. So I'm going to put that I added put spread, essentially turning it into an iron condor. I'm going to save this as a new trade. I will copy the link. I'll put it in the description down below for you so that you can all open it up, check it out yourself, and maybe model different variations of that you might consider to be appropriate for you. And again, the goal here is education and studying paper trades.